Okay, well, thank you for having me. I'm especially happy to be here in Sweden, as when I'm talking about this issue in Finland, the response that I typically get is that, okay, yeah, you have a point there, and you might have even an argument there, but we are part of the Eurozone, and we cannot do anything for the monetary system, so let's forget about it and continue our lives as before. So at least that is not the response that you can give me here in Sweden. Well, yeah. But yeah, now to the issue. This is based on my PhD that was published last year. It's freely available online. And what I'm going to talk about today is I want to give you some historical examples of this. Joseph was already hinting to these issues. Then I also try to evaluate these types of reform, sovereign money reform, based on normative evaluation. And I'm talking about normative, even though I talk about democracy and economic stability and so on and so forth, but that are really politicized. But of course, they are normative goals as anything else. Then I have also built an economic model. I present that if I have time, and then try to conclude. So to introduce, these are the research questions that I try to answer. I had many others also in my PhD, but I have only 15 minutes, so I had to drop some of them. But first, before going to the historical examples, this is how I try to conceptualize this whole issue. I use full reserve banking as an umbrella term, so it catches all types of reforms based on public money, but also on commodity money. So these types of 100 reserve banking proposals that are based on commodity money, even though those are a bit different kinds of proposals. And then I have the sovereign money system that I'm trying to focus on. And then I have also the deposited currency. I just follow the title that James Tobin gave it in the 80s. So that's the CBDC there, and there's also other types of. But I think there's still need for conceptual work. These are not really well consolidated, and some people talk about full reserve banking when they're referring to the Chicago plan, and so it's not really clear what we are talking about. And this is just to show that the proposals are very diverse. Now to the historical examples. Full reserve banking was actually experimented in the US and the UK in the 19th century. In the UK, there was the Bank Charter Act that prevented private money creation, but it prevented private money creation only considering bank notes. So cash was at that time basically nationalized, or at least it had to be fully backed by government securities or gold. So that's also one type. And then the US did the same thing during the Civil War. And macroeconomic indicators either continued their previous paths or then pointed a bit upwards, but it's hard to say. I will show you some indicators in a moment. But as I said, that this reform covered only bank notes, so cash was basically then moved to as a public good, but that basically created the system we have today. So it didn't cover bank deposits, and that's the system we have lived ever since. So the foundations haven't really changed after that, after the 19th century. Okay, these are just some indicators to show that what happened when the reform was put in place in 1844 in the UK, and real GDP growth peaked, at least plus minus 6 years there, and inflation was about, I don't know, 3% or something like that, and it went up a little bit later. And was this because of the reform? I don't know. But at least what I know is that it didn't cause an economic collapse. I think this is a good evidence for that. The GDP didn't go down very much, at least. And that's a good argument that at least some of the fears might be unjustified. And actually, the US is running a full reserve banking system today, in the sense that it has more reserves. The banking system has more reserves than there are deposits. So moving to this type of sovereign money system might be quite easy. At least the transition phase will be easy. Of course, each bank doesn't have more reserves than deposits, but on the aggregate, that's the case. And of course, banks could lend the reserves then and even the differences out. Now I will move to the normative evaluation. I have democracy, economic stability, social equality, and then ecological sustainability. What happens to democracy? Of course, there are pros and cons here. This has a lot of support in surveys. Almost all surveys that I have seen, the majority of people will respond that how the money system should work. Should money creation be the prerogative of the public sector? Most of the at least respondents say that yes, it should. But of course, when you then ask in Switzerland, there was a referendum on this last summer, and then they answered no. So who knows what's the real answer there? Okay, and then of course this yields some sign-off revenue for the government. I will show you in a moment how much. And then of course there's also the fear that it could cause corruption and abuse, that the government is not perfect either, and the government might not be democratic, so it doesn't, in that sense at least, foster democracy. So this is the transition sign-off. Basically this means how much government bonds the central bank will have to buy, so that there will be the reserves will equal the narrow monetary base M1. And as I said, in the US, the transition has already happened. Then there is no revenue there, and in the UK, Euro area, and Finland, it will be like 30 to 55% of GDP. But this is only the transition period, and this data is, I think, from 2015 or 14, and so the Euro area didn't have the QE programs then, so these numbers have changed after that. But more interesting is this: how much sign-off revenue will this type of reform yield each year annually? So it depends. I've just simply calculated how much the money supply has grown in the past, and if it will continue growing at the same rate. And then, of course, how big is the money supply? It depends how much sign-off you will get. And it would be something from 1 to 7.7% of GDP. So quite significant, I would say. Then economic stability. Well, I won't go through all the points here. Obviously, the payment system will be secured. That is one of the I think strongest arguments for this type of reform. As of course, if banks go bankrupt, then it means that the payment system can still continue to operate, and that will be important, of course. And well, there are a lot of other issues. Then I think the best counter argument is that near monies might emerge, and this relates, of course, to the discussion whether one should pay interest on this on sovereign money or not. I think, yeah, who knows, might happen, but at least last time we went forward and we had bank deposits, and then we have, of course, these kinds of all electronic payments and so on and so forth. So even if it would be undermined by near monies, I think it would mean that the technology will go forward, and it wouldn't be such a bad thing. And yeah, well, credit crunches might occur, but well, if I have time, I can come back to this in the panel discussion. Social equality, yes, in the sense, if you have a broad concept of social equality, so new money will be distributed evenly, or at least in a democratic way, that that the parliament will do that. But then again, it will not necessarily have any direct impact on income inequality. So that might not have a big impact there. We might not see a big impact there. Ecological sustainability, I want to take part of this discussion whether there is some kind of growth imperative in the current monetary system. And what I have concluded here is that there might be, but only in nominal terms. So if money is created against loans, it means that the loans usually, actually I haven't seen a bank that doesn't charge a positive interest rate. So it means that you have to make the money grow somehow. It's up to you how you can make it grow, either in the financial markets or in the real economy. But anyway, you have to make it somehow grow so you can pay back the loan. But this doesn't imply that there is a growth imperative in real terms. So of course there's inflation too, and that might mean that there's negative growth too. But what is the conundrum that I had in the title? It's the international aspects. What would happen in the international or how successful would the reform be depends a lot how the international political community and the economic or business community will react to such a reform. And the answer is, I don't know. It depends. It depends all on a belief. How different actors think that how this might work or not. Will, for instance, investors see a country that will implement this type of reform as a safe haven or a possible risk for the investments? I don't know. It depends. And this needs a lot of research to be done. And this hasn't been really researched before, so I think this is a really interesting research question in the future. So now the economic model, I have 3 minutes. I don't have enough time to go through it, but I just want to show briefly that this is a stock flow consistent, this is a balance sheet and transaction flow matrix. But this is these are the findings that basically I compare money creation under sovereign money or full reserve banking system to money creation under full reserve banking still, but without increase in government expenditure. Government expenditure increases without money creation, and then also how government expenditures increase under the current monetary system. So basically there's no difference in any of the cases, and that should be obvious if you think that what matters are, of course, the monetary flows and not that much the stocks what determine these issues. But what changes is how much debt there is in the economy. So you see that when money creation occurs under the full reserve banking system, there's less debt in the economy, even though the government increases expenditure only for one period. And why there's less and not the equal amount? In this case, exactly the same amount of money is created than the government increases expenditures. It's of course because some of the increased expenditures come back to the public sector as tax revenue. So this is the reason why there's less debt in the economy, or at least in the public sector has less debt. So it means that the fiscal space of the government will increase in this case. Okay, one more minute. Then I have also a lot of other experiments. I don't have time to go through them all, but it also implies that there's also relatively smooth and small changes in interest rates, so it won't cause a credit crunch either, or fluctuating interest rates. But then if you create money only through quantitative easing, it doesn't have really an impact as no monetary flows happen there. That should be also quite obvious. So this is also one explanation why QE doesn't really work for the real economy. And now to conclude, just to recap my main points, full reserve banking was experimented in the 19th century, and at least it didn't cause an economic collapse. That's what I can say as a researcher. it might have a positive impact on democracy and economic stability, maybe also social equality, but no impact on ecological sustainability. And the success of this type of reform deeply depends on how the international community reacts. So that this is a big issue of future. But who knows? More research is of course needed, but one suggestion is also that let's implement this type of reform, or CBDC at least, and see how the economy develops. I might be wrong. I think it might have a positive impact, but if I'm wrong, then we can move back to the previous system. Thank you.